good afternoon to our members and our guests, and welcome to this Invest Africa webinar on debt in Africa. A quick bit of housekeeping, as you heard, please do stay on mute for the duration of the webinar, but the live chat is available in terms of questions and the panel would like to hear from you, so please do submit them as we go through the conversation, as we're going along. We will be recording it and the recording will be made available to you as members after the event. And so, because this is such a big topic and such an interesting one, it is my pleasure to hand you over to Yvonne Ike, Managing Director and Head of Sub-Saharan Africa at Bank of America. Yvonne will be chairing our session today along with our excellent panel. And if I can just bring to your attention who they are, although I know they are actually all household names to you. So I have Aurélien Marly, who's Vice President, Senior Credit Officer and Sovereign Risk at Moody's Investor Services. We have Charlie Robertson, who is Chief Global Economist at Renaissance Capital. And last but certainly not least is Ibukun Adebayo, who is Director and Co-Head of Emerging Markets at London Stock Exchange Group. So a very warm welcome to you, and Yvonne, look forward to an excellent conversation in your hands. Thank you very much.
Just very quickly, thank you very much for organising this very important topic in West Africa. As usual, stepping into the fray to discuss that which is important for the continent. I couldn't think of a better group to have this conversation with today. I look forward to some of the nuggets that will come out of this, and I look forward to the impact that it will have on discourse around this topic. I just want to set the context a little bit, just in terms of looking at the debt crisis that we had, and just stepping a little bit way back to 2008, 2009, when I think these are the most recent points to look at. And so we had the debt crisis then, and then we had the oil shock in 2014, and then we had the oil shock in 2020 together with the COVID crisis. And what this has done for African economies is actually last year, for example, increased the overall debt profile by 8 to 10% across the countries. And the overall impact on this has been that the debt to GDP ratio for African countries, and it's one measure, but it's a very important measure, is really too high and just does need to be managed. And right now, on average, it's about 50%. So just breaking that down a little bit, that's around $80 billion, forgive me, against a GDP of over $1.6 trillion. And 50% of that is local debt, and the international debt is about 50% of that. And I think it's important that we make that distinction as we go through this conversation today. There are recent IMF reports that suggest that the region needs at least another $300 to $400 billion over the next 2 years to get us out of the current cycle that we're in. There are a number of tools out there, whether it's the debt service suspension initiative that we'll talk about today, the G20, both of them are G20, and then the G20 common framework. There's initiatives that the bilaterals are doing. There's the DFIs, particularly the World Bank, are supporting. What we want to discuss is it appropriate? Is it enough? What can the African countries be doing themselves? What should the international agencies be doing as well? What are the ideas that we can take forward? So I'm going to go straight into the conversation by inviting Charlie Robertson to answer the first question, or discuss the first question around, do you think the multilateral development banks are doing enough to support debt sustainability in Africa?
It's if I can start by saying, the reason there's an issue at all is because of the savings shortage across particularly much of sub-Sahara. So there's no shortage of savings, and interest rates are very low in a country like Morocco or Mauritius. But there are a whole host of other countries with this shortage of savings. Now, what's been happening for the last 10 years is governments have been borrowing to try and invest, to improve infrastructure, to give them what's required to go with the huge educational improvement that we've seen in the continent over the last decade or two. We've got to the point now where adult literacy can is sufficient for industrialization, very fast growth, but there isn't the infrastructure to go with it. It's all very well having well enough educated people to work in a factory, but if there's no electricity, that factory is not going to work. And if there's no railway, there's no way to get those products out to market. So that's what we need to see happening. That's part of what's driven up the debt burden. Whether we're in a debt crisis in the 2020s or not, I think massively depends on what happens in the US Treasury market. And just 6 weeks ago, looking at a chart now, we're at 1% on US 10-year yields. And if that had been sustained, I was assuming that global investors, yes, some would choose Bitcoin because, hey, why not? But others might say 1% in US 10-year, that's nothing. I'm going to lend to sub-Saharan countries at 5%. And such low levels of interest rates would then enable countries to carry a much higher level of debt than in the past. So tremendously important to me as to where the US Treasury yields go, because right now they're heading up towards 2%. And at that point, you start to say, okay, it needs to be what, 6% in sub-Sahara, 7%, maybe more. And then the debt burden, that high level of debt that's been built up, or the higher level of debt that's been built up, becomes harder to afford. And then the multilaterals have to step in and do something. Or governments themselves have to just cut back on all their infrastructure spending and have a very tight ship, but low growth, and not then produce the infrastructure that is needed for economies to industrialize. So I'm paying an awful lot of attention to the US Fed at the moment, which last night hasn't helped. And I'm hopeful that at some point in the next few months that we will see a fallback in yields, global markets then saying, we'll lend and at cheaper rates than ever. And that's going to keep at bay a debt crisis and give governments time to borrow, to invest, to build the infrastructure, to industrialize, to then grow out of the debt. That's what would be the ideal scenario for the next few years.
Okay, so thanks for that, Charlie. So you've talked about US Treasury yields, you've talked about savings levels. What's your view on the typical level of growth rates that we need to see across the continent, and any other macro conditions, whether it's commodity prices, that you think will help with the current situation? Because we'll talk about the external, which is what I'm asking you, and then we'll talk about some of the internal things as well.
Very roughly, with the dependency ratios that we have across sub-Sahara at the moment, you should be looking for something like 4 to 5% growth. That's typical of economies with this ratio of adults to children, or adults to children and pensioners. But the countries that beat that 4 to 5% are the ones with very good education, and the ones with a lot of electricity and the industrialization theme. So countries that have massively beaten that sort of number, obviously China over the last 20, 30 years, Vietnam, now Bangladesh. Countries that don't have the metrics to industrialize underperform that figure of 4 to 5%. And then we start talking about, what, 3% growth, even less in South Africa's case in recent years, and which is a whole another can of worms I'm not going to get into now. South Africa's a different kettle of fish. But the point being is that we should be looking for something like 4 to 5% growth. The question is whether you can have an investment-led boost to that for now, followed by a continuing boost to that from industrialization. And that's uncertain and still depends on the level of interest rates.
Okay, yeah, so definitely, and just a bit of context around the comment that Africa is not a country. So when we talk about I want to give some perspective on the parts of Africa that are struggling and the parts that just need more conversation. So we all know that Zambia defaulted late last year. We also know that in Ethiopia, DRC, and Mozambique we could argue are potentially on the brink. There are other economies like Angola, Ghana, Cameroon, and Gabon. The last 4 countries have concerns, but are also addressing solutions. And the total GDP, I did a quick back of the envelope calculation. See, the total GDP of these countries is about between $300 and $400 billion, which means that 25, and let me stretch it a bit, 50% of the GDP of the entire continent is really at risk. So we have a problem, but it is manageable. And when we look at the context of the common framework, the G20 common framework, I want to ask you, Aureline, do you think that it goes far enough on debt forgiveness for low-income countries?
And for the moment, we haven't seen any case that has been finalized through the common framework. If you let me, I would like to take a step back. You had the G20 that started an initiative, the Debt Suspension Service Initiative, last year that lasted 6 months. But it was a very modest liquidity relief. And at the same time, you had, and you mentioned that in your previous questions, the international financial institutions such as the World Bank, the African Development Bank, the IMF, that did a lot of support through budget support and lent a lot of money to the government last year. But of course, the shock has been so severe that the deficit have grown, the revenue were lower than expected, and as you mentioned, the debt of most of these vulnerable countries had already been rising for quite a number of years, and therefore the increase due to the pandemic is putting a lot of pressure on some countries, and therefore the G20 decided, again, in order to help these countries, to renew the DSSI, but this time inside the DSSI, they put the common framework, which is a mechanism where the debt will be restructured with a clause more forceful clause that will involve the private sector, or at least seek a treatment as favorable as the one received from the G20. Ethiopia has formally applied, and we will see what the outcome is. We put Ethiopia on review for a possible downgrade. And what we understand also is that in the common framework, the clause, the risk of involvement of the private sector is more visible. It's more, there will be no, and it's non-negotiable that the clause will appear in the term and condition of the memorandum of understanding that will be signed by Ethiopia. 2 other countries have already also indicated that they will choose the path of the common framework, Zambia, that defaulted, as you mentioned, and also Chad. We don't rate Chad. But so it's 3 countries that decided that they will go for the negotiation with the G20 to restructure their official debt, but with a clause that says you will have to involve the private sector. There might be exception. There is a list in cases it makes the situation more difficult, or the size of the debt of the private sector is so small that the G20 may allow some exception. But I think the bar is very high, and even though it's not a certainty that the private sector will be involved, the risks are much higher than in the previous version of the DSSI. So the fact that this framework exists is really because the G20 and the multilaterals as well, they think that some country will be on a debt trajectory that is unsustainable, and therefore it's better to act now and position the debt through to a more sustainable path. As far as Moody's is concerned, we think that our rating speaks to the commercial and private debt. So if there is we try to answer 2 questions. Will the private sector be involved in the restructuring? And if yes, what will be, we try to estimate the expected loss that will ensue. And if, to give you an example, the expected loss is at 5%, in that case, the rating is already in the CAA category at CAA1 or lower. And if of course, we anticipate that the losses are even higher, in that case, the ratings has to reflect these higher losses.
Yeah, and one of the implications of the common framework is that they will not, at least the countries that go into that framework will no longer have access to the public capital markets while they're in that program. What are your thoughts on this? I'm going to throw this to Aureline and to Charlie about these countries not having that option. Does it matter? Is it better for them? What are your views?
This is so first, we don't give advice to government, but we understand why there is these clauses, because the official sector has been very clear on that. They are ready to support the government and support these sovereigns that are facing very large difficulties, but they don't want a non-limit period where taxpayer money through the official channel will help to service, for example, also the debt of private sector money that is costing much more to borrow, and that will prevent the more concessional money to help also to put back the debt dynamics on a better footing. So there is a logic to that that is understandable. Now, for the sovereigns on the countries, some of them, I say, we value the access to the international markets to a point that is much higher than the liquidity relief that is offered in the DSSI. You are a country like Nigeria that did not participate, Benin also, and so on. There is a list of countries that have not participated to the DSSI. But if the situation becomes too difficult, there will be no alternative than maybe go to the common framework.
Charlie?
Well, I mean, my view is that governments are better off having a broader access to more finance, whether it's via the LSE, for example, and we're going to hear about that in a second, I think, or China or Eurobond markets. Ethiopia only borrowed one Eurobond ever, so I can understand why they're prepared to take a risk. I mean, I was quite intrigued to see that an advisor to the Prime Minister's office is thinking that they won't necessarily have to restructure their Eurobond, which and Eurobond pricing is suggesting that some people believe that. I'm more with Aureline that the hurdle's very high. So I would have thought that Ethiopia is going to lose access to the markets for some time. Zambia is too, and I assume that's because the president's not looking much beyond August, and he's just thinking, am I going to get re-elected? And he's not really thinking that, how am I going to borrow to grow this economy after that? And I think that's the place they've ended up at. But I think most countries are saying, no, if we can still raise finance from the private sector, Ghana, Kenya, Nigeria, Angola's doing the right thing, that broadens our choices and allows us to continue this investment growth model. While Zambia and Ethiopia is going to be much more difficult, and growth, I would have thought, will be slower unless they do something very different on the currencies, and that seems to be the opt-out option for governments. Weaken your currency, give yourself a surplus on the current account, and then you still have an inflow of dollars that you can use to invest, which actually is what Angola is doing as well. So not only are they keeping market access, but they're also letting their currency be very cheap, which I think is very helpful for them. So I think it's a shame, anyway, to see countries cut themselves off. But when the debt level is too high, it's too high. So sometimes it has to happen.
Yeah. So on the topic of doing things differently, and we talked about the local markets. The first question I had regarding capital markets is, what role do you think the development of local capital markets has in fiscal rebalancing?
I think it's a very, very dynamic question in terms of a series of dynamic answers. But I think ultimately, African capital markets continue to be underdeveloped and not able to service requirements of the entire economy, whether that's private sector debt or public sector debt. I think a lot needs to be done there in terms of adjustments, better auction processes, better price discovery, more international investors, all these things that we know about and are very comfortable and familiar with the need to change. But ultimately, there is the key issue which continues to be crowding out of the private sector in local markets, which is where we feel a relief channel tends to come from the ability to also issue for sovereigns overseas, the international capital markets that supports the type of yield requirements that are needed by overseas investors. So what we as London Stock Exchange are keen to do and have been doing with markets like Nigeria, markets like Angola, markets like Morocco is seeking to have greater cooperation between our capital markets authorities, ultimately around more mutual recognition so that we can bring opportunities for issuance to market much more quickly in a combined framework that works not only for the international market, but for bringing those rules and covenants back to local markets as well. So I think that's a really important factor. And once local markets get that momentum, then I think you start to see that rebalancing of the issues around fiscal matters in the local market. But I believe these problems are not localized. They should be looked at particularly by sovereigns in terms of the full opportunity and interest in international investors investing in local sovereign paper.
So you've talked about that, and that's the local capital markets. Are there things that governments can do internationally as alternatives to raising taxes or reducing their spend? Well, actually, we should all be thinking about how spend is reduced in these countries, to be honest. But, are there any other ideas outside of the local debt capital markets that you've talked about?
So I think before we can leave local debt capital markets behind, I think we have to talk about the alternatives to raising Eurobonds. One of the biggest issues around debt servicing is, the issues around currency volatility, depreciation, and ultimately that risk issue, particularly for sovereign issuers, the private sector issues as well from Africa. The tools that are in the arsenal of international investors are significantly more suited to managing currency risk. So one of the areas of cooperation now between UK governments, so for example, the Foreign Commonwealth Development Office and Nigeria last year got together with the major authorities in Nigeria to discuss the possibility of local currency financing for sovereigns in international markets. And what that does is shift that risk burden to the international investors who we believe have a better opportunity to deal and mitigate that currency risk. There are issues, and the issues locally are you prepared to have a reference price for your currency being set overseas in an international market? I know a lot of central bank governors are not too keen on that idea, and there are macroprudential issues to consider there, and also hot monies potentially coming into domestic markets and creating asset class bubbles, etc., are all potential issues, but all containable in legislation frameworks that can be put together to mitigate that. But I think that's something that is increasingly becoming more amenable, and we are in discussions with a number of unnamed governments at this point in time on how they can develop an offshore yield curve backed off of the multilateral development banks that IFC listed at Naira paper. We've seen Kenya paper, we've seen other paper from international development banks. So there is definitely a trajectory for the sovereigns to look at potentially raising capital off of the back of that good work that's already there in the market.
That's great. And in addition, there are also other alternatives governments could be looking at this time, whether it's asset sales where appropriate, securitizing some of the flows of some of their assets. And all of these can be done in international markets as well as. So I think it's important that we all continue to focus on discussions, not just around debt management, but also other sources of revenue for the governments as they work their way out of this very tough time. I want to take it back to Aureline to just say, I know you don't advise government, but when you're looking at governments and ranking the ones that do well, clearly you're looking at measures for improving debt revenue, domestic revenue collection. And do you have any thoughts on things, different things that can be done differently with that in that regard?
So it's keep in mind that we look at a lot of things, including the capacity to generate more revenue for the government, because ultimately it's the main source of resources for the government to pay for the infrastructure and to create an environment that improve the living standard of the population. But at the same time, it's also the resource that help to service the debt. And what we do with this pandemic is that across the board, lower revenue to GDP. And the question is that will the recovery be strong enough so that first you see a sufficient rebound in revenue to cover for the drop, but also is the recovery will be sustained over time, meaning that we still don't know if the damage inflicted by the pandemic are structural, in particular for the informal sector. There are a lot of discussion about the capacity to increase revenue in Africa. The revenue in many countries are less than 10% of GDP. So definitely, when you do a comparison across region in the world, you had countries that were and that still are poorer than some African countries in East Asia and in Latin America, and they still raise revenue higher than in Africa. So if you take a country like Nigeria, the level of non-oil revenue is only 3 to 4% at the best of GDP. It's the lowest in the world. So there are questions around the ability also, and it also indicates maybe an institutional weakness that we take into account also in our ratings to create the situation for the revenue to increases. A number of countries have taken big step in the last few years. Even a country like Angola introduced VAT, for example, to have revenues more. The reliability of revenues is increased because it's linked to a transaction in the country. But I think this is a fight that authorities will have to continue because their GDP is growing. So often you have a rebasing and you realize that despite all the effort that have been made over 5-6 years, when they rebase, in fact, they are still low. So they were even lower in the previous period. And that element is absolutely key, especially now that with the pandemic, you have bigger deficit to fund. So I know that you say a spending cut is maybe not the right term, but maybe it's a rearrangement of the spending. There are maybe some savings to be made so that the deficit is reduced, because if the deficit are not reduced, the debt will continue to go very fast upward and will be unsustainable. And the revenue are also key because at the moment, there is a difficulty to fund externally because yields are volatile. Charles mentioned it. Ibukun also with the vis-a-vis of the local market, but current account deficit has grown. Most of African countries are commodity exporter, and during the pandemic, you had a shock, a loss of imports. And what we call the external vulnerability indicator at Moody's is something we follow. And you had pressure on currencies because the reserves were down. So the ability to secure some external funding at this stage at concessional or favorable term, if the country is not able to export a lot or at a good, favorable price, it's also important. So all these things is something that we monitor, the strength of the recovery, the capacity to generate revenue, but they are linked, and also the capacity to fund also externally when you add external pressure that have grown.
And I want to throw that topic open to Ibukun and to Charlie as well, because it's such an important one, and is at the heart of the restructuring and progress away from the current situation, which all indications are that it will be a tough ride for most African countries for the next 2 to 3 years at the least. And if we then look at the fundamentals around local currency that Aurélien touched on and other dynamics, what are your thoughts on how to improve the domestic revenue situation?
Let me come in, Yvonne, if I may. The one thing that this crisis has brought to the forefront of everyone's minds is that these challenges are huge and broadly at the moment insurmountable and need different techniques, different approaches. And one thing that has become more and more evident is that African economies actually have access to more revenue capital than they probably realize or have imagined. But it's going to take coordinated effort in order to recover money. So let me explain what I'm trying to say. The UN Conference on Trade and Development has identified that approximately $90 billion worth of illicit financial flows come out from Africa on an annual basis, which would effectively make Africa a net exporter of capital. Now, those monies are parked in overseas jurisdictions, enabled by advisors who create the structures, who create the opportunity for these acts of malfeasance to take place. Now, there are a contingent of newly democratic or anti-corruption minded African governments who are now making efforts in order to recover those monies. Now, when I talk about recovering these monies, we're talking about huge amounts of money. Sudan, in particular, have civil litigation claims at the moment for maybe $3 to $4 billion. In terms of what that could do for Sudan, in particular in relation to their IMF program and some of the other covenants they have around currency stability, etc., could be huge, could be enormous. But it would take a concerted effort by the private sector and the governments to come together to enforce that civil litigation, to bring back this capital. And this is true for nearly every country. We saw just very recently nearly $300 million returns to Nigeria from the Sani Abacha regime. That brought in coordination from the Bailiwick of Jersey, US authorities, UK authorities, and the Nigerian authorities. And that capital is now being reused and monitored in a managed repatriation fashion to build bridges and roads and other things. But that capital could also be brought back to pay off the bilateral debt obligations that these countries have, which I think is an extremely important prospect, but again, would require the coordination of authorities to do that. The last point I'll make on that is, as we go on, the use of proceeds for Eurobonds, investors will become more and more discerning. They will not wish to pay off the debt obligations of those countries. They will want the monies that are used in Eurobonds effectively to create GDP increasing transactions, money spent on infrastructure, money spent on social matters, education, water, COVID-related areas and issues, even related to the transition that's required from a sustainability point with those countries. Now, if that move and that shift from investors comes to that, then there will need to be these types of alternative options for countries to find other means of sources of capital. And we know the capital is out there. We know that there's a certain amount of complicitness from the international financial centres to allow these transactions to happen. This is not all African corruption. There's equally some culpability by those advisor enablers. And the stronger the message is to say that you cannot do that anymore, you cannot enable these transactions anymore, the better will be for the African economies and their opportunity to create self-sufficiency around their own fiscal matters.
You raised some very fascinating points there. I just want to pick up on two of them, just for the sake of time. The first one is around the return of funds, the illicit funds that have come from different African countries and around the world. And you talk about coordinating with the authorities. I wanted to just stretch that a bit more and say, is this something that you think that the African Union should be standing together and negotiating with international countries as a whole in terms of a framework of saying, where is this money? You know what you can know where it is. Let's agree how much it is across the different countries. So just as we have the African Free Trade Agreement, that we come up with an idea where we have an African illicit funds repatriation program. I'm sure there'll be something more user-friendly to call it, but that the AU comes together, creates a framework that negotiates as a body with the international countries. That if we focused on 3 or 4 countries abroad for these African countries, a lot of money would come back, and then that there's a framework for redistributing that money to repay debts in the first instance, and also in a managed way to invest in things like infrastructure, etc. So I think that idea of return of funds, and I'm sure Karen is listening somewhere, is something that I think we should all advocate for to be done more robustly at this time. And I think it will make the same international bodies that we go to renegotiate debt more amenable if they think that there is some way we can rebalance the equation, so to speak. So that's a very important one. The second one I wanted to just touch on that I thought was very interesting is just more rigor around the use of proceeds. And again, I think it's not so much the investors dictating, and I'm sure that's not what you mean, but it's much more around the countries themselves as they step forward into the international markets, that there's some sort of common standard or framework about what they spend their money on and how they will self-govern around the spend of that money. And I think if there's something that the investors can see that's more consistent across the countries, that also would also help in terms of just more strategic debt management as we go down the line. Charlie, I wanted to just take that back to you and get your views on this topic, on this question.
No, I think what Ibukun's been talking about in terms of what can you do today to try and make a difference on a 6 to 12 month view is really valuable. And anything from diaspora bonds to making it easier to invest in local markets is a great idea. I guess what I'm thinking is we could be having this conversation again in 5 years' time or 10 years' time if the structural reasons for low savings in Africa are not addressed by the governments that need to do the most. So there's no shortage of savings in Morocco, none at all. You can borrow at 2% at the long end in local currency or euros, whatever you like. There's no shortage of savings. The reason for that is because they got the fertility rate down below 3 kids per woman back in the 1990s. And when you get your fertility rate down, households start to save money. When there's a shortage of savings, of course you want to diversify your risk. If you've invested some capital in a country and you know this is a savings shortage country, there's always going to be the risk your savings get stolen. So you put some offshore, and that's been the capital flight story out of Africa for decades. Or India before that, or South Africa, or Russia. I mean, you name it. But once you get the fertility rate down, household savings explode. Foreigners can't access the local debt market in India. They don't need to. Indians have got so much savings, they can finance the growth themselves. China's got so many savings because it's got a low fertility rate that it's sending hundreds of billions of dollars abroad, into Africa, in fact, over the last decade. So what needs to be done then is, if we're not going to be having the same conversation in 5 or 10 years' time, is a really concerted effort by governments to encourage families to go down the lower fertility route. And it doesn't have to be coercive. And it's been done in countries like Bangladesh, India. It's been done in Morocco. It's happening slowly, but it's happening in Egypt. Just encourage people to have less families. It used to happen in Indonesia. I worked with a colleague, and when he was going to school back in the day, you'd see these big posters saying 2 kids is best. I'm not best because I failed on that front, but there is still the argument this is smaller families create savings. And when you've got the surplus of savings, we won't be having to have this conversation in 10 years' time, and your interest rates come down too. This is what makes it so helpful. So just when you've got this huge demographic surge of young people coming into the labour market, as Sub-Sahara's got right now, what it needs is incredibly low interest rates at the same time. Now, if you time the whole cycle well, as China did, or as India is doing now, Bangladesh is doing now, you've got cheap capital and a huge workforce. What do you get? Massively high growth. And the reason Sub-Sahara's, or a country like Nigeria, is struggling is the fertility rates there, 5.5, well, more than 5.0 kids per woman. So there's no savings. Capital is extremely expensive, but you've got millions of new entrants coming in and saying, where's my job? And there isn't one, which is why unemployment is at 30%. The government has to do something to try and make sure that we're not repeating this same problem in 10 years' time. But it doesn't help for 6 months, which is why what Ubicom has been talking about is so valuable, and what you're suggesting too. Sorry, it's my latest talking horse.
What do you think they should be doing, and how do you encourage savings when interest rates at the moment are at an all-time low for savings in Africa? How does that?
But there's no savings. No one can have savings where you've got 5.5 kids on average. I mean, a few people will, but the vast majority do not. So there just isn't a savings pool. You can do a little bit on mobile money. You can do a little bit about trying to trap capital in the country, as Ethiopia has done. But even then you run out of the cash because there just isn't very much local cash.
No savings. What about currencies? What can be done for currencies across the board that might help the situation, attract more FDI into the economies, help with more strategic infrastructure spend, help create a surplus on the current accounts, help fiscal space? What about currencies? What role does currencies have? What do you think about commodity prices?
That helps too. So high commodity prices means that, you know, if you're in Nigeria, first half of 2008, there's a lot of money flushing around the economy at that time. Stock market was going mad because actually oil was so high that there was a surplus of savings for a while. So having a cheap currency policy helps. But the difficulty about attracting in lots of foreign direct investment is, who wants to put a factory into a country without sufficient electricity? Electricity is hugely expensive. How do you fund an electricity cheap electricity? You have to do it through your local savings normally. That's how China did it. That's how India is doing it. But local savings are so expensive because there aren't any in Nigeria that it's a real problem. So a really cheap currency does help compensate for that. It reduces interest, well, it creates sufficient amount of dollars in the system locally that actually does help bring down interest rates. So this is why, again, I think Angola is doing the right thing. Even Zambia is going to be in a better position with this cheap currency today. But countries with too expensive an exchange rate, like Ethiopia or Nigeria, have a problem.
Yeah, and I think also the pension funds, increasing the amount of pension funds in the countries also will help greatly. I'm going to, Aurélien, you're going to answer the last question, if you please, about, you know, what do you think are the long-term solutions to restructure African debt? And then we'll open it up for conversation with the panel in the last 10 minutes. So Aurélien, if you could, please.
You know, I work for a rating agency, Moody's. So when you talk about the long-term solution to restructure African debt, it rings bells because Just to give you an anecdote, in 2013, I published a paper within Moody's called Sub-Saharan African Issuances. You had a wave of new issuers around Africa. Everybody was excited. They were able to issue bonds in good faith to fund infrastructure, electricity, roads, logistics, and the yields were lower. I remember Zambia, it was lower than Italy, for example, at that time. And I was interviewed, and I said at that time, the issue is that this wave of issuance is not tested. It will be tested in 10 years when the money is due to be paid. And we see the pressure now on some of the countries that borrowed, where there is no plan and there is not the fund yet to repay the bond that matures. So the point is that if the countries will default, and we position some rating to match the pressure there is on these countries, it will entail a restructuring of their debt. It's the basic what we learned from the past is that prior support from the bilateral institutions or multilateral institutions, they ask for a restructuring of the debt, but the default is really damaging for the economies. Generally, it's accompanied with devaluation of the currency. This is why I'm not that supportive of what has been said on the currency, because the most vulnerable in these countries are the ones that take the brunt of the loss of purchasing power. It creates also political instability down the road. I think the stability is more important, but when country default, there are a lot of sorts of challenges that are present that make the re-emergence difficult. So I think the best way will be to try to avoid restructuring the private commercial debt. But with the situation we are in, and the G20 having created the common framework, we expect more countries probably to choose the path of the debt restructuring, because there is a framework that will negotiate with the G20, offer a relief, and then they will have to seek to impose that relief at least as favorable on the private sector. And that element creates the mechanism to reduce the debt for the countries that cannot sustain the debt. But as a rating agency, we don't we expect to not have a lot of default happening in the region.
Yes. Okay. That's great. Do any of you have any last words on this topic before I go into the questions that the panelists are sharing with us at this time?
I just wanted to ask Aurélien, because I think it's a really important point about the currency devaluation issue. And would the current account surplus not make you feel a little bit, I understand the debt ratio will look much worse, the external debt will look much worse, but would the current account surplus not reassure you from a rating agency perspective that there is a supply of dollars there to fund the interest?
You need to look at the whole balance of payment. You can have a capital surplus and still a drop in reserves because you have huge external liabilities to pay, and therefore the surplus is a good position to be in if it's sustained, because it could lead to accumulation of reserve if the balance of payment is sound enough. But I think what is important to attract FDI is stability. What we see is not depreciation that are managed by the government. Often it's they have to devalue because they lost. There is a shock, or there is a drain in the public finance, or they have to use the past accumulated surpluses in the reserve, and so on. It's not something that is well organized to say, let's give, for few countries have done it, let's use a bit of the currency to devalue by 5% a year to give a bit of competitiveness to our export. It's not what we see in most cases.
Rwanda is doing that. It's had this kind of crawling peg monthly devaluation. Does that influence how you feel about that credit?
I mean, we look at everything. With the external pressure is one element, but it's not the only one. I think we didn't discuss too much, but we hinted to it. The strength of the institutions is very important. You have countries, and we painted a picture that is rather pessimistic on the continent, but you had bright spot. I mean, a country like Côte d'Ivoire has been using well the resources, increase its revenue, grown very fast, been resilient to the current pandemic, and has been able to borrow in November 1 billion euro, for example, last November. So it's really also the ability to deliver on what the executives they say they will do, and create also the sector that will generate the dollars in the future with the money that is borrowed.
And if I just add in that, I mean, copper prices are what, 7 or 8 year highs right now. This should be great for Zambia. It should be great for DRC. We've got oil prices back up at best amongst the highest levels we've seen in 6-7 years. Also good for Nigeria and Ghana, and gold is pretty high. So actually, this is quite a good commodity time right now, at a time also when interest rates globally are still quite low. So it should be quite a good 2 or 3 years, would be my hope.
It should be. We must at this point turn over to a couple of questions that I'm seeing on the dashboard. The first one, and I'm going to throw this out to whoever chooses to answer it, is: are there any views on a new allocation of SDRs by the fund?
I think it's a good thing, but Aurélien probably knows better on this issue than I do.
I mean, it's first for the advanced economies, and then there will be probably, if it happens, there will be some that will be for the most vulnerable countries, but the bulk will be, for example, probably designed for large emerging market or advanced economies that have difficulties. I don't expect that to be the, but we need to see. It's not done yet.
Did you see the proposal from the CGD? Guido Moore, who's the guy in Washington, and also a really cool lady out of Kenya as well. And they suggested that advanced economies give up some of their extra special drawing rights allocation and hand it over. Hannah Ryder, sorry, it was the lady from Kenya. But anyway, that seems like a quite a helpful thing for them to be doing.
Yeah, I agree. Sorry?
It may happen.
It should happen. It should happen. Question on Zambia. So as we discussed earlier, there's an election coming up in August. So the typical boilerplate discussions is around a deal with IMF/raising taxes. There's a question here about that being a political no-go in an election year. What are the other ideas for that could help Zambia in particular with its debt restructuring? Ibukun, let me ask you if you have any thoughts on that before I go back to Aurélien.
So I would fall back to the response that I gave before, maybe give a little bit more shape and colour. The outstanding assets that Zambia has in terms of illicit financial flows have absolutely been identified. Now, those assets have value. Those assets are essentially claims which have value, which can then be, for that reason, priced and can be very, very carefully and meticulously brought back into the economy. Now, one of the things that why London Stock Exchange has a deep interest in this is that because of that valuation opportunity, it's possible to effectively securitize those claims and crowd in private investments into the enforcement of those claims and almost create something like a privatization vehicle that will transcend not just the current administration, but another administration by having it listed on the local Zambian stock exchange. Effectively, you have a Zambian recovery fund, which continuously is made evergreen by local asset managers and others that are interested in the pursuance of patrimony for these countries to ensure that there's a vehicle that is constantly restituting capital back into the country. Now, these sorts of ideas are pretty left field, And they've not been tested in the sovereign world, but they are very, very established methods in the private sector around areas like corporate issues, divorce law, etc. The civil litigation, the issues where we have with African economies in making this type of initiative work is that it's always been led by criminal claims and criminal pursuance. If we purely think about the money and bringing back this stolen patrimony through a civil type process, then you have a difference. And this is potentially something that Zambia could look at.
Okay. I'm liking this idea more and more about this whole recovery fund. Sounds a lot more interesting than the name I gave it before. As we wrap up, and we have the last 2 minutes, I'm going to just do a round robin, Ibukun, Aurelien, and then Charlie. You know, what are your last words on this topic about something different that we should be thinking about, or we should be admonishing the African governments and the international communities to think about as we look at this debt that is unmanageable for some economies, but not a disaster by any means. There are ways around it, as we discussed earlier on this call, and it'd be nice for us to end on a good note. And one of the good notes is that the commodities backdrop now is much better than it was this time last year. So, you know, what else do we admonish the governments and the international agencies to do, and governments to do as we round up on this discussion? Ibukun, over to you.
So I was very impressed with the speed at which the African Development Bank came up with their COVID resilience bond, and the international donors and institutions that invested into that. Now, how does that relate to debt issuance? Well, debt. How does it relate to reducing debt? Well, I think it takes the pressure off the country in terms of those specific domestic spends. And I think that is, again, a part of the international coordination of effort that can be replicated and can be scalable across the continent.
Great. Charlie?
I thought what Ibukun was suggesting for Zambia was a really cool idea, so I'd do that.
It is. But you can't say that. You have to tell us something different.
Second thought was that, I mean, governments can think about managing exchange rates, Asian style, keep them cheap, keep them predictable, take control of the process, and try and sustain current account surpluses. And the third thing would be perhaps to make it really easy and publicly accessible for when you do borrow money to spend on infrastructure. Here is the justification for it. So I got a little concerned about a railway plan from Kano to Niger, and I'm struggling to see how the $2 billion will pay for itself, how it'll make money on that. And we've already seen problems in Ethiopia and Kenya with the railways not bringing back the returns that people were hoping for. So publish the assumptions that are explaining why this spending is happening on this, this project rather than that project, so that people can judge it for themselves, make it easy, transparent.
Yeah, so I think, again, I really like the idea of publishing the assumptions and making the transparency, or increasing rather the transparency around the spend on the more strategic things like infrastructure and industrialization that gets these economies out of the way. I do agree with Aurelien that in terms of managing exchange rates, the most important point is the stability of it. That's just making that the central governments are more focused on doing what they can in a more market-friendly way to ensure stability, as opposed to them necessarily being the lowest rates that they could be. Aurelien, just one last word from you before we wrap up on this discussion.
We cannot be prescriptive, but I think I'm hopeful for the continent over the long term, because what has been done is still nothing compared to the needs, and at some point capital needs to be invested somewhere that makes sense. So you have growing population, growing economies. As Charles explained, there is a case for a positive growth on the continent and the subcontinent for the decades to come. With the growing population, you need more services like healthcare, education, banking system that can lend long term for the housing and so on. And when we think to all the infrastructure, and I don't think Africa in the 21st century could be excluded from the rest of the world like it was in the past. And therefore, one way or the other, that's my personal opinion. I'm quite hopeful, even if it means that in the meantime, due to the shock and the difficulty, there could be a bit of instability for the government to reorient their policies probably and do better and be more effective than they have been for the last decades.
Thank you very much for your contributions. I must call it a wrap at this point. I want to end by thanking Invest Africa for continuing to provide a very important platform in so many ways, including platforms for us to discuss these types of topics. And we look forward to doing and hearing more from you. Thank you, Invest Africa.
Thank you, Yvonne, and thanks to the panel. We could have carried on for another hour. What an amazing panel, and I think I should start to patent some of these ideas myself. So thank you very much for your contribution and great sharing, Yvonne. Thank you, everybody.
Thank you very much.
Thank you.
Thank you.
Bye.